Hi, this is Richard Flax at Moneyfarm with our regular monthly update. We're recording this on August 7th. We've seen a lot of market volatility over the past week or so, with sharp moves down and up in US and Japanese equities in particular. We wanted to discuss that in a bit more detail. There's been a lot of debate about what prompted these big market moves. And as the dust begins to settle, we can think about three reasons behind the weakness we've seen. First, concerned about earnings in some of the big tech stocks that have driven the US market higher over the first half of the year. Second, concerns that the US economy is now slowing faster than expected, raising the risk of a recession. And third, that investors in Japan have been surprised by changes in monetary policy and been forced to sell some of their positions. So if that's a fair assessment, how should we think about it? In the US tech sector, expectations are high, and some companies didn't achieve quite the results that analysts had expected. That can create a lot of short-term noise, but we'd still argue that the long-term outlook for these large tech businesses is pretty positive. In terms of macro, we've seen a shift in expectations over the past couple of weeks. Most analysts would have told you that they expected the US economy to slow down from here. We've seen that in the labour market for some time. Job creation is still decent, but not as strong as it was 6 months ago. But after a couple of weaker than expected labour market reports, you hear a lot more about the possibility of a recession in the US. We currently think that the US economy will slow, but it won't fall into a recession. That's an important assumption, and one that we'll keep checking. But for now, we think that inflation will slow down enough for the US central bank to start cutting rates in September, even if we also think that it might not cut as aggressively over the next 12 months as some market indicators would suggest. As for the volatility in Japan, we think it's a combination of changes in monetary policy, combined with investors betting against the Japanese yen. That has caused some really sharp moves in markets, but we don't think that it changes the long-term positive investment outlook for Japanese equities. In terms of portfolios, the weakness in equity markets has weighed on returns over the past few weeks, but that's coming after a period of low volatility and strong market performance. At the same time, it was good to see the benefits of diversification, as bond positions in portfolios helped to reduce some of the market volatility. While we are watching US macro data carefully, we do think that some of the concerns over the past few weeks are overdone. In general, we think our portfolios are fairly conservatively positioned and that we have scope to increase our equity exposure. It's easy to stay the course when things are going well. It's more of a challenge when markets are volatile and uncertain. But we continue to believe that this has generally been the right approach to look past the short-term noise and make sure that you're invested in a well-diversified portfolio that's consistent with your long-term goals. Thank you for listening and look forward to speaking to you again soon.